Yeah, so the key skill in Chapter 10 is your ability to link this year's budget to domestic economic stability or internal stability, which basically means you need to be able to explain how this year's budget will help to achieve the goals of full employment, strong and sustainable growth and low inflation. It's important to recognise that it's not all good for these goals. So while we're going to talk mainly about policies designed to improve these goals or to meet these goals, not every single policy in this year's budget is going to help growth. But the good thing is most of these contractionary policies, which we've talked about, that are designed to achieve fiscal consolidation, are not likely to have a really big negative impact on aggregate demand. So while some restrictions on welfare and making people pay higher HECS can lead to less aggregate demand, overall there's no really key policies that should hurt long-term growth, except for the fact that maybe less people would get an education because of the higher costs of welfare. Of university. So what we're going to look at in this budget is three key policies that can be linked to both growth and inflation, or keeping inflation low, being the first three here: income taxes, company tax cuts, and the accelerated depreciation allowances. So strong and sustainable growth, they're three key policies that can be used for strong and sustainable growth. So the 7-year personal income tax plan is the key policy we're going to look at. The continuation of the company taxes, which is part of the 10-year enterprise tax plan, and then infrastructure spending as well. So essentially with the changes to income tax, they're done in 3 stages. The first stage was announced in July 2018, so this year. The second stage is in 2022, and the final stage is in 2024. And what they're planning on doing is offering relief of up to $530 to middle and low income earners through a combination of tax offsets and changes in the tax brackets. So the two key things for this year's budget is they are offering an additional, there's already one that exists, but an additional tax offset of $530 which will go to low and middle income earners. And basically what that means is that they'll be able to reduce their tax liability by around $530 come tax time. So an increase in the low income tax offset of $530. In combination with that, they're going to raise the 32.5% tax bracket from $87,000 to $90,000, which means that anyone earning over $87,000 is able to earn an extra $3,000 before they get pushed into the higher tax bracket of 37 cents. So they will save 4.5 cents on all their earnings between $87,000 and $90,000. They are the two key things from this year's budget. So as you can see with this tax bracket here and this one here, the 32.5 cent tax bracket used to finish at $87,000 and then this one would kick in. Now it goes all the way up to $90,000 and the 37 cent tax bracket doesn't kick in until you earn $90,000, saving you around 4.5 cents per dollar on everything you earn between $87,000 and $90,000, which equates to a saving of around $135 to anyone earning above $90,000. If you're on $88,000, you're only going to save $1,000 worth of that instead of $3, so you'll save 0.045 times $1,000, which will give you a saving of around $45. And as you can see from this, the main people that benefit from this budget are those in the middle to low incomes. Your high income earners don't get the tax offset, so that gets reduced the more you earn. They only benefit from the increase in the tax bracket, 32.5 cent tax bracket. The programmer, why they've got the biggest one, is they benefit from both the changes to the tax brackets and they also benefit from the changes in the tax offset as well. In 2022-23, the government is going to raise the 19 cent tax bracket from $37,000 to $41,000, which means you can earn an extra $4,000 before you have to start paying the 32.5 cent tax bracket. Again, designed to increase people's disposable incomes, leave them with more money, and therefore help to boost consumption spending. The third policy is that at the same time they're going to increase the 32.5 cent tax bracket from $90,000 to $120,000. So you won't start paying 37 cents in the dollar until you earn $120,000 instead of $90,000, which is going to save people significant amounts of money. So this bracket here goes all the way to $120,000, and this bracket here will go to $41,000, the 19/7 tax bracket. Again, if you look at the savings, most of these are going to benefit high income earners going forward, and even more so when we look at the next run. And the last phase is that they're going to completely eliminate the 37 cent tax bracket. So this bracket in here is going to go, and people are going to pay 32.5 cents from $40,000, because the 19-cent tax bracket will go up to 40,000, all the way to 200,000. So they're making the tax brackets very proportional, or a lot less steep, and everyone earning between $41,000 and $200,000 will be in the same tax bracket of 32.5 cents, which will save people, if you do the maths, currently it's 90,000, you start have to pay 37 cents. So you're saving 4.5 cents on $110,000 of your income, which equates to quite a bit of money, over at $4,500. That's why a lot of people have an issue with this, is because high income earners are going to get most of the benefit. These changes will ensure that most Australians don't face a bracket above 32.5%. So 94% of all taxpayers are actually going to be in that middle bracket. It's a very proportional tax system. And as you can see, so this bracket here, instead of going to 87,000 like it was last year, it's going to go all the way to 200,000, and then the 45-cent tax bracket will kick in. Okay, so there's 3 different phases. This one's the most important to know because it's going to affect growth in the short term. You can't really talk about this in relation to growth in the next few years because it doesn't take effect for another 7 years. And as you can see from the table of savings, most of the benefits accrue to high income earners from the last tax cut savings. Okay, second policy, lower company taxes. What the government's doing, there's a little bit less to this one. They're basically lowering the tax rate from 30% to 27.5% for all businesses earning less than $50 million. So in last year's budget, all businesses earning less than $25 million paid the lower rate of 27.5%. In the budget before, they increased, they made it 27.5% for anyone earning less than $10 million. And increasing it to $50 million this year will mean more people or more companies will pay the lower rate. The lower corporate tax rate is extended to companies, anyone earning less than $25 million last year and $50 million this year. By the year 26-27, all companies are only going to pay 25%. The idea of this is to promote investment spending and create jobs in the short term by boosting aggregate demand. And in the long term, as we invest in more technology, become more productive, it should help to reduce cost-push inflation and allow for non-inflationary growth and reduce inflationary pressures. So the lower company tax rates can be linked to inflation and growth, but it's important to recognise that the benefits for inflation are only long-term. In terms of inflation, another policy you can use, and this is also related to taxes and growth, is the accelerated depreciation allowances. So businesses are able to write off any asset purchases worth less than $20,000, and in this year's budget they've extended it so you can do that for another year up until June 30th, 2019. So any business with a turnover of less than $10 million is able to purchase equipment and claim some of it back in tax or reduce their profits. So if it costs you $20,000, assuming you reduce your profits by $20,000, that will allow you to reduce your tax by around $6,000. Because you would save 20,000 times your tax rate, which is for big businesses is 0.3 or 30%, and for smaller businesses 27.5%. This policy was initially introduced in 2015-2016, has continually been rolled over every year so that you can continue to do it now until the middle of 2019. The idea of this is that, again, it can lead to more growth in the short term because of more investment, and in the long term it helps to boost our productive capacity because we invest in new technology and new machinery, which leads to lower cost of production. So it has both short and long-term benefits for our economy, but only benefits inflation in the long term through the fact that businesses become more productive because of their investment. Thank you.